what is a dividend, what is the importance of a dividend, and 3 things to look for when investing in a dividend stock. All that and more coming up on Stock Smarts. So welcome back, ladies and gentlemen, to another episode of the Stock Chief channel. Today I want to start a new series called Stock Smarts, where I'm going to go along and teach you guys some of the basic things about stocks so you can be a better investor as your investing career expands. So today we're going to focus on a dividend stock and a dividend in general. So let's go ahead and take a look. First of all, leave a like if you're enjoying the channel and hopefully enjoying the series. Leave a comment below on other things you want to learn about in the stock market and investing world, and please subscribe to the channel as well. It helps me out a lot. And if you want to, hit the notification bell so you can keep up to date when all of these videos are posted. So let's get right into it. First, let's take a look at what is a dividend. So here, the Google definition, the dictionary definition of a dividend is a sum of money paid regularly, typically quarterly, but sometimes can be monthly, by a company to its shareholders out of its profits or reserves. So this is just a fraction of the earnings or a large portion of the earnings from a company that they pay out to their shareholders. And what is the importance of a dividend? Well, the biggest thing for a dividend is it's a constant form of cash flow. And what I mean by that is even if the stock loses value, you're still going to have a dividend if it is truly a dividend but a dividend stock, dividend yielding stock. So let's take a look at Disney. And this touches on the 3 important things to look for when investing in a dividend stock. I wouldn't necessarily classify Disney as a strictly dividend stock, but I would classify it as a growth stock with a dividend yield. So as you see in the bottom right-hand corner here, see if I can't highlight it. No, I can't highlight it, but in the bottom right-hand corner of the Robinhood app in the stats section, you see the dividend/yielded, or just the dividend yield. And as you see, it says 1.44. And what that means is it's a percentage. So you move the decimal point 2 over to the left, and then you figure out the dividend yield if you want to do it in percentage. So when you scroll up to the Disney ticker symbol and the Disney current value, you see that it is 142. So what that means is when you take the dividend yield to calculate the dividend yield, or to calculate the total dividend you'll be earning over that year, you take the 1.44, you multiply that by the 142, and roughly you're going to come out with about $1.50, $2 over the course of the year. When you multiply that out. Now that's off the top of my head. I could be off. It could be a little more. It could be a little less. And that also depends on the payout ratio, which is the second thing that we need to talk about. But to stay on this for a second, and then that dividend that you calculate, it's going to be broken down into 4. Into 4, you're going to divide it by 4. And what that means is quarterly, you're going to get paid out 1/4 of the $2 or whatever it may be for the various stock. When you look at that, it's going to be 50 cents, it could be 40 cents, it could be 60 cents per quarter. You're going to be earning per share of the dividend stock that you own. It just depends, and that leads right into the payout ratio, which this is something that you need to look at when investing in more of a growth dividend stock, because it shows the potential growth that the company could have and the growth in the dividend that they could potentially increase that over time. So let's take a look at Disney's payout ratio, if I can find it right here. So currently, as you see right here, if I can highlight it just above that, it says Neo stock. Currently, it says the dividend is at 0.19. And again, that is a percent. So you're going to move that 2 to the right for this one. I said that wrong earlier. So you move it 2 to the right. Okay. And it says, so that would mean 19% is their payout ratio. So that means 19% of their earnings, they're paying out to their shareholders in dividend. So when you look at this number, this is a very important number. It could mean a number of things. I've said number a lot recently, but that's okay. So the minimum over the last 10 years has been 16%. The maximum has been 37%. That is very low. That is very low for a company of Disney's size. Many of these things you're going to see like 40 or 50 or even higher, because of these companies are so massive they can spare that. But Disney is a company that's constantly reinvesting their money to acquire new other companies and all sorts of things, and expand their parks and do all sorts of things like that. But they've also increased their dividend through at least over a short period of time. Not quite as much as other stocks, which we'll talk about in just a second, but they've increased and they've stayed steady. But with a dividend, with a payout ratio of just around 20%, lower than 20%, you see a potential for a lot of growth. This company could potentially get to around 50%. So 50% of their earnings will be paid out in dividend. Now that's all speculation, but it is very possible for a company of Disney's size to do that and to continue increasing their payout ratio and their dividend over time. Other companies, one thing I will say to be aware of is if the payout ratio is close to like 75, 90%, that is going to be strictly a dividend stock, and likely they're going to have to cut that dividend stock. And a great way to see if they're good companies, if you look back at 2008, 2009 with the crisis, the economic downturn, you'll potentially see if they cut their dividend, that means it's not necessarily the strongest company, but if it's increased since then, you have a pretty good indicator. But potentially when a company is paying out 90%, have a 90% payout ratio, they're not going to be able to withstand some of these recessions and things like that, because of the fact that that's simply, they're not going to be able to do that if they're paying out 90% of their earnings. How are they going to stay afloat when the economy goes downward? So pay attention to payout ratio. It's very important. You don't want it to be too high, but you want it to be in a good spot, especially if you're looking at a growth stock, a growth dividend stock. You want it to be a little bit lower so it can potentially expand, and then your total yield is going to increase over time. So hopefully this dividend yield will eventually get to 2 and then potentially even 3. And then maybe settle right around there. But that's a very good, for a company of Disney size, that's a very good dividend yield. And then the third thing is going to be PE ratio. And as you see, that is just above the dividend yield on the Robinhood app. So you see PE ratio, price to earnings ratio. So let's look at the definition of that real quick. So PE ratio, the price to earnings ratio, also known as PE ratio, is the ratio of a company's share price to the company's earnings per share. The ratio is used for valuing companies and to find out whether they are overvalued or undervalued. So what that means, and I'll break that down into more layman's term, what that means is, for this one, since Disney's is $16, that means every dollar you invest into Disney, it's going to take Disney is going to need to earn $16 for you to earn your $1 back. So people can view that as a good thing. People can view that as potentially Disney is going to be great. They're going to be earning so much money, and they're going to earn, who knows what, 25 or whatever. And then the PE ratio would be undervaluing the company. Or you could look at it as a bad thing. When you invest $16, they're going to only earn, or it's going to take, when you invest $1, they're going to need to earn $16 for you to earn that dollar back. That could be a bad thing, because that's a lot of money to be putting into a company, and then they'll have to earn a lot of money for you to even get $1 back. So you could look at it as a good or a bad thing. Some people look at, you need a low not dividend but PE ratio, so that it doesn't take a lot for the company to earn your dollar back, and it's a quick return on investment. Or you can look at it, if it's like 22 or whatever, that the company is going to earn a lot of money, and they're going to meet that, and they're just going to expand in the future. So you could look at it as a whole number of things. I tend to look at it as on the smaller side, but 16 is not too bad. It's not too bad, especially for a company of Disney's size. So the final thing, not of the 3 things I look at, but this is a very important thing to look at when you go to, just as another thing to know for a company, is going to be dividend aristocrats and dividend kings. What that means is a dividend aristocrat is a company that has increased their dividend steadily or drastically, it doesn't matter, for the last 25 years or more. A dividend king is going to be a company that has increased their dividend yield for 50 years or more. So you got to think about that. That's something, 25 years or 50 years. You've been through multiple economic recessions and downturns. Even for 25 years, you've been through multiple economic cycles and all sorts of things. That is crazy to have been able to do that. So let's take a look at some of the companies that are on this list. You've got new companies such as AT&T, Colgate, Franklin Resources, and Cisco, and all those companies listed there. This is a Wikipedia site, but it does a good job of showing all the companies that are on there. Then you have 3M, AbbVie, Archer Daniels Midland, which is one I'm invested in. Again, AT&T, Caterpillar, Chevron, Coca-Cola, which I believe is a dividend king. I could be wrong. If it's not, it's very close because they're a very good dividend stock. ExxonMobil, Hormel Foods, Lowe's, McDonald's, Pepsi, Stanley Black & Decker, Sherwin-Williams, Target, and Walmart. And Walgreens and all sorts of stuff. I believe there's about 57 dividend aristocrats and obviously a lot fewer dividend kings. So if you want to stop the video, I'll scroll through for a quick second. You can stop it and take a look at the list, or you could just go to Wikipedia in general. So that's another thing to look at. If you're investing in a dividend aristocrat like AT&T, and I'll show you that real quick because they do have a high dividend yield, and you don't want a super high dividend yield around like 10 or whatever, but AT&T has 7. Theirs is 7.04. That's a very high dividend yield for a company, but when you've been increasing your dividend for a long time, and I believe their payout ratio isn't even that crazy. I believe it's somewhere around 50 or 60%. I could be wrong, but I'm pretty sure that's where it's close to. And you've got a big company like AT&T. This is like the first or second biggest mobile phone, internet, and TV, and all sorts of things company in the world. You're very safe when you look at dividend aristocrats like that because they've been increasing their dividend for 25 years. So even if the company loses a little value in the stock market, they're still going to have that dividend, and it's still going to potentially, increase over time, like I said. So AT&T, very good, even though the dividend yield is quite high. I feel great about this stock. So yeah, that's going to wrap it up real quick. So this was a history lesson, not history lesson, but basics of a dividend in a dividend stock and all the things you need to know. So again, if you liked the video, please leave a like. If you didn't, leave a dislike. And if you made it to the end of the video, leave a comment on your favorite dividend stock currently, or the dividend stock that's made you the most money in the past. I will leave a link in the description for a free Robinhood stock if you sign up today, or not today, but in general. And like I said, stay tuned for the next one, and happy investing.